Over the past couple years, having your money in a high-yield savings account or even a good money market account has been such a smart move because it gives out a guaranteed 4 to 5% on your money. Your regular savings account is likely giving out something like 0.01% to maybe 0.15% if you're lucky. So this is something like 400 to 500 times more profit. I have some bad news for you though. Things are about to change. Pretty soon, high-yield savings accounts are about to lower their rate. So if you're used to getting 4 to 5%, now you're going to be looking at something like 1, maybe 2%. In 2020, banks sharply cut rates in half from the year prior. Some of the most popular high-yield accounts cut their rates in half in 2020 compared to 2019 to, or close to, 1% compared to 2 to 2.5% in 2019. My Savings by Nationwide, which offered a 1.5%, switched to 1% APY. Ally Bank lowered its yield from 1.5% to 1.1%. The other piece of bad news is the question of, was having that money in the high-yield savings account necessarily the best option for you? Yes, this is a guaranteed 4 to 5%, and so for most people, having a good sustainable account where your money is guaranteed, you're not going to lose any of that money, that might give you very solid peace of mind, and that's even more important than profit itself. But was that the best move financially? Let's just say you had $100,000 and you put it into the high yield savings account at the beginning of 2023 at Capital One, which offers 4.3% APY. Over the year, you would have earned $4,300. This is awesome, so good job. However, had you had your money in something like the S&P 500 for 2023, the return last year was 21.9%. So instead of making just $4,300 in 1 year, you would have made almost $22,000, which is 5 times more. Had you had it in QQQM, which is a growth ETF that I love a bunch and I have a lot of in my account, that one gained over 55%. Which is just insane. So in 1 year, you would have gained over $55,000 had you had it in that account instead. So let's talk about why high yield savings accounts and money markets and even bonds are going to be cutting their rates and why that's going to slash profit for you in the very near future. Then I'll explain why high yield savings accounts and these types of accounts can still be a good move, but you have to use them correctly. I'm still gonna have a portion of my money in these types of accounts, and I'll explain exactly how by the end of this video. My name's Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. The reason why rates are so favorable and nice right now in our high yield savings accounts and in bonds and in money markets is basically because of COVID and high inflation. Kind of. 40-year high inflation prompted the Fed to raise rates in 2022 by 4.25 percentage points over 7 meetings throughout the year, including 4 hikes of 0.75 percentage points each. In 2023, a total of 4.25 percentage point rate hikes took place. The rate hikes happened so that it basically is more expensive for us to borrow money. By increasing the rates, what it does is it should counteract inflation and it should bring that down overall because it's lowering spending a bit. At the very least, it should be slowing down its effects. It makes borrowing money more expensive, which is why it costs more right now to buy a house or to buy a car or pretty much anything where there's an interest rate attached to it. But also, for those of us that are saving money, this makes it very favorable because that rate goes up as well. Congress mandates the Fed maintain economic and financial stability. The central bank mostly does so by raising or lowering the cost of borrowing money. Savings account rates are loosely linked to the rates the Fed sets. After the central bank raises its rate, financial institutions tend to pay more interest on high-yield savings accounts to stay competitive and attract deposits. Conversely, after the Fed lowers its rate, banks tend to lower their deposit account rates. Over the past couple months, we've seen that this high interest rate time that we're in has been working its magic, and it has been pulling down inflation year over year. The Fed has announced rate cuts to be expected by the end of this year in 2024 and then throughout 2025 and 2026. As they cut rates, it's going to make things like buying a house or buying cars much easier because that interest rate is going to be lower, so you're going to be paying less each month. but it's going to make that high yield savings account APY drop substantially. The Fed funds rate was taken all the way down to a range of 0 to 0.25% in March 2020 in response to the worldwide COVID-19 pandemic. Earlier in the video, I showed that from year 2019 to 2020 and how they slashed those interest rates, and it made it so that high yield savings accounts were getting much less per year. We can definitely expect that same thing when they cut rates later on. So how should we use these high yield savings accounts? I still have a high yield savings account and I'm still going to continue using it. I'm just not going to be adding very much to it over the next year or two. I still need a place that holds my emergency savings that I'm not going to touch, and it's just there for literally an emergency. Even when the high yield savings account rate does drop from like 4% all the way down to 2% or 1%, that will be sad, but that's going to still be your best option. All the other guaranteed places are going to drop as well, and 1% is way better than 0.01% in your regular savings account. For money that one would need as an emergency, people should definitely be having that in the high yield savings account or money market account or CDs, somewhere that's not the stock market, not somewhere volatile where it can drop. If it's your emergency savings and you're literally keeping it for an emergency, you don't want anything bad to happen to that money, and you want it to be there if you need it. You also want it to be liquid, which means that you want it to be able to be used or be able to be taken out very easily. And in these types of accounts, that's what that's for. For money that you might need in the near future, like you're saving up to buy a house next year, or you want to buy a new car in the next couple months, that would be another place that you would want to have your money. You would want to keep it in the high yield savings account rather than try to get an extra 2 or 3 or 4% over the next couple of months in the S&P 500, because the possibility of it dropping is definitely a thing. For anyone that's looking to invest long term, that just means over 2 years. Definitely for those of you that are investing and you're investing for a retirement account, and you're not even going to be able to touch that till after age 59 and a half, and you're only 50 right now. That's called long-term investing. You definitely don't want to be putting that type of money in your high yield savings account thinking that's what's going to grow your wealth. Just because it's super safe doesn't mean that that's the best option. Now, yes, a portion of your money should be there, emergency savings, 100%, I agree with that. But if we're trying to build wealth, we want to go in with the highest upside and also limit that downside. Those of you that have been so smart and just have been putting that money into the high yield savings account, getting a guaranteed 4%, that's a very solid amount. To get 4% of a dividend per year in a very safe account, why not? But the best option now moving forward is going to be to find a high yield dividend type ETF that's going to be as safe as possible, so it invests in very boring companies that are very sustainable. They're not going to be super volatile up or down, but they're still going to spit out that nice 4% dividend. That's what we're looking for moving forward. Because like I said, since the high yield savings account rates are for sure coming down, we gotta find something new that's gonna produce that cash flow. Smart investors are putting money in this style of ETF where they're getting not only that solid 3 to 4% of a dividend, but also the possibility of growing 6 to 8% or so on just a share price as far as appreciation. And lucky for you, I just made a video on this, and this is the type of ETF that I'm buying like crazy over the next year or two, especially after that new CPI data that just came out. Watch this video to see which ETF I'm talking about. Or watch this one to just keep going strong in your investing journey.